China just weaponized silver. Yes, you heard that right. Starting January 1st, 2026, the world's largest silver producer is officially restricting exports, and it's about to break global prices. If you're holding paper silver, physical silver, or even just keeping an eye on precious metals, this is not something you can ignore. The signals are loud, clear, and impossible to miss. Ladies and gentlemen, Jason here. Happy New Year to you and your families from all of us at JW Capital. I hope 2026 is already off to a strong start for you. And if you haven't yet, go ahead and hit that like button, share this video, and subscribe to stay on top of the market moves that really matter. Now, here's the thing. The headlines aren't exaggerating. China's export control isn't some soft guideline. It's a hard regulatory move requiring government approval for every ounce leaving the country. What this really means is that 60 to 70% of the world's refined silver supply suddenly has a bottleneck. That's not minor, that's seismic. Let's break it down. Historically, global silver markets have been dominated by paper trading, COMEX futures, ETFs, and other derivatives. These allow traders to bet on silver without ever touching a single coin or bar. For years, prices have been dictated more by speculation than by the physical supply-demand equation. But China's move changes the equation overnight. Physical silver scarcity is no longer a distant theoretical problem. Vault inventories in Shanghai have already shown significant drawdowns, reaching levels not seen in a decade. And when physical silver becomes scarce, premiums spike. So while COMEX paper prices might wobble, Shanghai and Asian physical prices are setting new benchmarks. That gap, that divergence between paper and physical, is where real market opportunities and risks are hiding. Let's put this in context. Imagine you're a manufacturer relying on silver for electronics, solar panels, or EV batteries. You now face a situation where securing supply isn't a matter of paying the current price. It is about getting approval, timing, and navigating government regulations. Industrial demand doesn't pause, but supply is throttled. That's what drives premiums higher and fast. Meanwhile, Western paper markets might feel insulated at first. Traders can continue to buy and sell contracts without touching metal, but the physical squeeze is like a pressure cooker. When the disparity grows too wide, the paper market eventually adjusts, sometimes violently, and with the world's largest producer controlling the tap, the adjustment could be swift. This isn't speculation or hype. Data from Shanghai vaults shows drawdowns at their lowest point since 2016. Physical premiums over spot are climbing, and experts are already projecting $100, even $125 per ounce in 2026 if supply remains tight and industrial demand continues its upward trajectory. So here's the immediate takeaway. This is a structural shift, not a momentary blip. For investors, collectors, or anyone keeping an eye on global commodities, ignoring this development is a mistake. China isn't just participating in the market anymore, they're setting the rules. And when a country of that scale decides to weaponize its resources, markets listen. In the next few minutes, I'm going to walk you through exactly how this will affect global prices, what it means for paper versus physical silver, and why some investors might be underestimating the scale of this event. We'll also look at the potential ripple effects across other metals, currencies, and even geopolitical tensions. Stay with me, because if you're serious about understanding where silver is headed in 2026, the next few minutes could save you from blind spots that many traders and analysts are overlooking. Now let's dig into the nuts and bolts of what China just announced. Starting January 1st, all silver exports from China will require government approval. That's not just a bureaucratic formality, it's a real choke point. Think about it. China produces roughly half of the world's refined silver. When that supply suddenly becomes restricted, global markets feel it immediately. This isn't about maybe there will be delays. It's about a systemic squeeze on physical silver. Companies that rely on silver for electronics, solar panels, jewelry, or EV batteries now face a bottleneck. And as the industrial demand keeps climbing, every ounce that's held back pushes prices higher. Here's where it gets interesting. Western paper markets like COMEX might not react instantly. Traders can still buy and sell contracts without touching a single ounce of physical silver. But here's the catch. Those contracts are ultimately tied to real supply. When the physical silver supply tightens, the divergence between paper prices and actual silver in warehouses grows, and when that gap becomes too large, the paper market usually corrects hard and fast. Look at the data. Over the past few weeks, Shanghai vaults have been drawing down at an alarming pace. Premiums for physical silver are rising above spot prices, signaling the real scarcity that paper markets tend to underestimate. For anyone holding ETFs or futures, this is a silent alarm. But why is China doing this now? Some analysts point to geopolitics. Controlling exports gives China leverage not just over commodity markets, but also over industries in the West dependent on silver. If you're a government or multinational trying to secure silver for industrial production, this isn't just economics, it's strategy. China is effectively weaponizing its metal. Another factor, the upcoming surge in industrial demand. Electric vehicles, solar panels, and 5G infrastructure all rely heavily on silver. That demand isn't slowing. Combine that with restricted supply, and you have a classic supply-demand shock. Markets hate shocks like this, but investors who understand them can capitalize on them. Let's talk numbers. Physical premiums in Shanghai have climbed to levels not seen since 2016. Meanwhile, COMEX contracts are still trading close to conventional spot prices. That gap is a warning signal, one that's flashing red. When the divergence becomes too large, prices adjust, sometimes abruptly. That's why experts are now predicting $100 per ounce, even higher if these restrictions persist and industrial demand remains robust. And here's the human side of the story. Retail investors are still largely unaware of the severity. Many are watching ETFs or paper contracts and thinking silver isn't moving much. Meanwhile, in Asia, real silver is already becoming scarce. People who understand the difference between paper claims and physical ownership have a significant advantage right now. So, what should you be paying attention to over the next few weeks? First, watch Shanghai vault levels. They're the clearest indicator of physical supply stress. Second, monitor premiums over spot for coins and bars. And third, track industrial demand signals, particularly in solar, EVs, and electronics. All three of these combined will give you the clearest picture of where prices are headed. Finally, remember this. China's move isn't just a short-term market event. It's a strategic move that could significantly impact silver markets for the entire year. If you're really serious about protecting your investments or even finding opportunities, ignoring these signals is a mistake. Now, let's step back and look at the bigger picture. China AS move to control silver exports isn't just a local issue. It sends shockwaves across the global market. Major importers like Europe, the US, Japan, and India suddenly face a potential shortage. Industries that rely on silver, electronics, solar panels, medical devices, could experience disruptions if they don't secure physical silver fast. This is where the tension really builds. When supply tightens, prices spike. And when prices spike, markets that weren't prepared suddenly react. Imagine a ripple effect. Asian premiums climb, European buyers scramble, ETFs see sudden surges in demand, and paper markets finally begin to mirror physical scarcity. That's when the gap between paper silver and physical silver could explode, potentially sending prices far above current levels. Analysts are already running projections. A conservative scenario predicts silver reaching $100 per ounce if export controls hold through the first quarter. A more aggressive outlook, factoring in rising industrial demand and limited stockpiles, pushes it even higher, $128 or more. And these aren't just speculative guesses. They're based on real supply data, industrial demand trends, and historical patterns from past disruptions. Here's the practical takeaway. Physical shortages increase premiums on coins and bars. For investors, buying physical silver now may cost more than paper contracts. But when the market tightens, owning actual ounces could lead to substantial gains. Geopolitics adds another layer. Countries dependent on Chinese silver may accelerate stockpiling, increasing demand and creating a self-reinforcing loop. Restricted supply, rising prices, more demand, higher prices. This isn't theoretical. It's happening right now. Currency dynamics also play a role. While the US dollar is strong, any weakening could further fuel silver prices. Historically, silver and gold act as hedges when fiat currencies falter. Investors anticipating instability often turn to physical metals, especially those controlled by major producers like China. It's crucial to understand that not all silver is the same. Industrial-grade silver and investment-grade silver serve different purposes. Physical coins or bars provide more security against market shocks than ETFs or futures. Knowing this difference can be the line between gains and missed opportunities. The speed of this market is another factor. Unlike stocks, metals react sharply to news and confirmed supply data. One day, premiums may look manageable. The next, they can spike if buyers outpace available inventory. Timing and vigilance are everything. Lastly, human behavior amplifies market movements. When headlines announce China restricts silver exports, urgency drives buying. Investors rush to secure ounces, often overlooking minor price differences. This combination of perceived scarcity and real supply limits can create rapid, dramatic price swings. At JW Capital, the strategy remains simple. Stay informed, understand the physical versus paper gap, and track real supply signals. This is how you navigate a market being reshaped by strategic moves across the globe. So, what does all this mean for you as an investor or someone following silver markets? First, understand the rules of this new game. We're no longer in a world where paper contracts dictate the price. The reality now is physical silver scarcity, driven by China's industrial demand and export controls. If you're looking at the numbers, this is the moment where knowledge turns into opportunity. Timing is everything. Buying physical silver now might feel like a premium, but when the supply crunch hits full force, the price gap will widen dramatically. If you rely on ETFs or paper positions alone, you may miss the upside, or worse, get caught on the wrong side of a price surge. Physical ounces, properly secured, are your hedge. Here's a simple framework to follow. Monitor Shanghai settlement prices, track warehouse stock levels, and watch for industrial buying signals. When you see registered inventories falling and premiums rising, that's your cue. Combine this with global geopolitical awareness, new export rules, trade tensions, and industrial innovations, and you start seeing where the market is headed. Now, let's talk psychology. This is a volatile market. Prices will jump, dip, and sometimes flash red on your trading apps. Don't panic. Remember, the paper price is often a lagging indicator. Focus on physical reality. Factories need silver, inventories are dropping, and China is buying aggressively. The fundamentals are clear. As we close out today's video, here's the bottom line. The era of paper-silver dominance is ending. Physical markets now set the pace. If you're prepared, informed, and patient, you can navigate this transition successfully. Miss it, and you'll watch opportunities slip away while others secure the ounces. Ladies and gentlemen, thank you for joining me today on JW Capital. I hope this breakdown gives you clarity on the silver market and the forces shaping it in 2026. If you found value in this, hit that like button, subscribe, and share with friends or colleagues who need to understand what's happening before the market moves further. Before you go, I want to hear from you. Drop your thoughts in the comments. What's your prediction for silver in the coming months? How do you see these export controls and industrial demand affecting prices? I'll be reading your insights and might even feature some in upcoming videos. Well, Happy New Year once again. See you in the next video.